Hey folks, welcome back to the channel. We're thrilled to have you here today because we're about to embark on a journey that could change your financial life forever. Whether you're a seasoned pro or a complete newbie when it comes to credit scores, this video is for you. So grab a cup of coffee, get comfortable, and let's get started. Today, we're diving headfirst into the wild world of credit scores. You might have heard about them in passing, or maybe you've been obsessing over them for years. Either way, understanding your credit score is crucial. It's that three-digit number that can open doors to financial opportunities or slam them shut. But don't worry, we're here to make sense of it all. You know that three-digit number that feels like it controls your entire financial life? Yep, that's your credit score. It can be a source of stress and anxiety for many, but it doesn't have to be. By the end of this video, you'll have a clear understanding of what your credit score is, how it's calculated, and most importantly, how you can improve it. Yep, we're tackling it head on. No more confusion, no more fear. We're going to break it down step by step so you can take control of your financial future with confidence. Whether you're just starting out or looking to boost an already decent score, we've got you covered. Whether you're dreaming of buying a house, finally getting that new car smell, or just want to experience the peace of mind that comes with financial health, boosting your credit score is essential. A good credit score can save you thousands of dollars in interest over your lifetime, make it easier to rent an apartment, and even help you get a job. It's not just a number, it's a key to a better life. And trust me, it's not as scary or complicated as those fancy financial gurus make it seem. You don't need a degree in finance to understand your credit score. All you need is a willingness to learn and a commitment to taking action. We're going to make it simple, straightforward, and even a little fun. We're going to break down 10 powerful, no-nonsense steps you can start taking today to improve your credit score in 2024. These are practical tips that anyone can follow, regardless of where you're starting from. We'll cover everything from paying your bills on time to managing your credit utilization, and even some lesser-known strategies that can give your score a boost. We're talking practical advice, clear explanations, and maybe even a little tough love along the way, because that's how we roll here. We're not going to sugarcoat things or give you unrealistic promises. Improving your credit score takes time and effort, but it's absolutely worth it, and we're here to support you every step of the way. So, buckle up, grab your notepad, and get ready to take control of your financial future. This is your chance to make a real difference in your life. By following the steps we're about to share, you can build a strong credit score that will serve you well for years to come. It's time to unlock the power of a great credit score. Let's dive in. But before we get into the nitty-gritty, let's take a moment to understand why your credit score is so important. Your credit score is a reflection of your credit worthiness. It's a number that lenders, landlords, and even some employers use to assess how responsible you are with money. A high credit score can open doors to better interest rates, higher credit limits, and more financial opportunities. On the other hand, a low credit score can make it difficult to get approved for loans, credit cards, and even rental applications. So, it's in your best interest to keep your credit score as high as possible. Now, let's talk about how your credit score is calculated. There are several factors that go into determining your credit score, and understanding these factors is the first step to improving it. The most important factor is your payment history, which makes up about 35% of your score. This means that paying your bills on time is crucial. Even one late payment can have a significant impact on your score, so make sure to set up reminders or automatic payments to avoid missing due dates. The next factor is your credit utilization, which accounts for about 30% of your score. This is the amount of credit you're using compared to your total credit limit. Ideally, you want to keep your credit utilization below 30%. For example, if you have a credit card with a $10,000 limit, you should aim to keep your balance below $3,000. If your utilization is too high, it can signal to lenders that you're overextended and may have trouble paying back what you owe. Another important factor is the length of your credit history, which makes up about 15% of your score. This includes the age of your oldest account, the age of your newest account, and the average age of all your accounts. Generally, the longer your credit history, the better. So if you have old accounts that you no longer use, it might be a good idea to keep them open to maintain a longer credit history. The types of credit you have also play a role in your score, accounting for about 10%. This includes a mix of credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Having a diverse mix of credit types can be beneficial, as it shows lenders that you can manage different types of credit responsibly. Finally, new credit makes up about 10% of your score. This includes the number of new accounts you've opened recently and the number of hard inquiries on your credit report. Opening several new accounts in a short period can be seen as risky behavior, so it's best to space out your credit applications and only apply for new credit when necessary. Now that you understand the factors that go into your credit score, let's dive into the 10 steps you can take to improve it. Step 1. Pay your bills on time. This might seem obvious, but it's the most important thing you can do to boost your score. Set up automatic payments or reminders to ensure you never miss a due date. Step 2. Keep your credit utilization low. Aim to use less than 30% of your available credit. If you're carrying high balances, try to pay them down as quickly as possible. You can also ask for a credit limit increase, but be careful not to increase your spending along with it. Step 3. Don't close old accounts. Even if you no longer use them, keeping old accounts open can help maintain a longer credit history. Just make sure there's no annual fee or other costs associated with keeping the account open. Step 4. Diversify your credit mix. If you only have credit cards, consider adding an installment loan or another type of credit to your profile. This can help improve your score by showing that you can manage different types of credit responsibly. Step 5. Limit new credit applications. Each time you apply for new credit, a hard inquiry is added to your report, which can temporarily lower your score. Try to space out your applications and only apply for new credit when necessary. Step 6. Check your credit report regularly. Mistakes can happen, and errors on your credit report can negatively impact your score. You're entitled to a free credit report from each of the 3 major credit bureaus once a year, so take advantage of this and review your reports for any inaccuracies. Step 7. Dispute any errors you find. If you notice any mistakes on your credit report, such as incorrect account information or late payments that you know you made on time, dispute them with the credit bureau. Correcting these errors can give your score a quick boost. Step 8. Become an authorized user. If you have a family member or friend with a good credit history, ask if they can add you as an authorized user on their account. This can help improve your score by adding their positive payment history to your credit report. Step 9. Use a secured credit card. If you have a low credit score or no credit history, a secured credit card can be a great way to build or rebuild your credit. With a secured card, you make a deposit that serves as your credit limit. Use the card responsibly, and over time, your score will improve. Step 10. Be patient and persistent. Improving your credit score is a marathon, not a sprint. It takes time and consistent effort, but the rewards are worth it. Stay committed to the steps we've outlined, and you'll see your score improve over time. And there you have it, folks. 10 powerful steps to improve your credit score in 2024. Remember, your credit score is a tool that can help you achieve your financial goals. By taking control of your credit, you're taking control of your future. So, start implementing these steps today and watch your credit score soar. Thank you for joining us on this journey to better credit. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more financial tips and advice. And as always, if you have any questions or need further assistance, feel free to leave a comment below or reach out to us directly. We're here to help you every step of the way. Until next time, take care and stay financially savvy. Let's make 2024 the year of great credit scores for all of us. See you in the next video. Alright folks, let's kick things off with the first step to boosting your credit score, knowing where you stand. Understanding your credit score is like understanding your financial health. Just as you would regularly check your physical health with a doctor, you need to check your financial health by reviewing your credit report. This is the foundation upon which you can build a strong financial future. You can't fix what you don't know is broken, right? Imagine trying to fix a car without knowing what's wrong with it. You'd be lost, and you might even make things worse. The same goes for your credit score. If you don't know what's affecting it, you can't take steps to improve it. That's why checking your credit report regularly is crucial. It's not just a one-time task, it's an ongoing process. By making it a habit to review your credit report, you stay informed about your financial status and can make timely decisions. Think of it as a routine checkup for your financial well-being. Think of your credit report like your financial report card. Just as a report card in school reflects your academic performance, your credit report reflects your financial behavior. It shows how well you manage your debts and repayments. A good credit report can open doors to better financial opportunities, while a poor one can hold you back. It tells lenders about your borrowing and repayment history. Lenders use this information to assess your credit worthiness. They want to know if you're a responsible borrower who pays back debts on time. Your credit report provides them with a detailed history of your financial behavior, helping them make informed decisions about lending to you. It's the information they use to decide if you're a responsible borrower. When you apply for a loan or a credit card, lenders look at your credit report to determine the risk of lending to you. A good credit report can lead to better interest rates and loan terms, while a poor one can result in higher costs or even denial of credit. And just like you wouldn't want a bad grade on your permanent record, you don't want errors or negative marks dragging down your credit score. Mistakes on your credit report can have serious consequences. They can lower your credit score and make it harder for you to get credit when you need it. That's why it's essential to review your credit report regularly and correct any errors you find. That's why you need to check your credit report from all three major credit bureaus, Equifax, Experian, and TransUnion, at least once a year. Each bureau collects and reports information differently, so your credit report from one bureau might not be the same as from another. By checking all three, you get a comprehensive view of your credit history. Each bureau might have slightly different information, so checking all three gives you the complete picture. Remember, knowledge is power. When you have a complete understanding of your credit history, you can take control of your financial future. You can identify areas for improvement and take steps to boost your credit score. By regularly reviewing your credit report, you can catch any discrepancies early on and take action to fix them. This proactive approach can save you from potential financial troubles down the road. It's about being vigilant and taking charge of your financial health. Now, let's dive deeper into why your credit report is so important. Your credit report is a detailed record of your credit history. It includes information about your credit accounts, such as credit cards, mortgages, and loans. It also shows your payment history, including any late payments or defaults. This information is used to calculate your credit score, which is a numerical representation of your creditworthiness. Your credit score is one of the most important factors that lenders consider when deciding whether to approve your credit application. A high credit score indicates that you are a low-risk borrower, which can lead to better loan terms and lower interest rates. On the other hand, a low credit score can make it difficult to get approved for credit and can result in higher interest rates and less favorable loan terms. There are several factors that can affect your credit score. These include your payment history, the amount of debt you owe, the length of your credit history, the types of credit you have, and any recent credit inquiries. By understanding these factors, you can take steps to improve your credit score. One of the most important things you can do to improve your credit score is to make your payments on time. Late payments can have a significant negative impact on your credit score. If you have trouble remembering to make your payments, consider setting up automatic payments or reminders. Another important factor is the amount of debt you owe. Lenders look at your debt-to-income ratio, which is the amount of debt you have compared to your income. If you have a high level of debt, it can be a red flag to lenders. To improve your credit score, try to pay down your debt and avoid taking on new debt. The length of your credit history is also important. A longer credit history can have a positive impact on your credit score. If you are new to credit, consider opening a credit card or taking out a small loan to start building your credit history. The types of credit you have can also affect your credit score. Having a mix of different types of credit, such as credit cards, mortgages, and loans, can be beneficial. However, it's important to manage your credit responsibly and avoid taking on more credit than you can handle. Finally, recent credit inquiries can also impact your credit score. When you apply for credit, lenders will make a hard inquiry on your credit report. Too many hard inquiries in a short period of time can lower your credit score. To avoid this, try to limit the number of credit applications you make. In addition to these factors, it's also important to monitor your credit report for any errors or fraudulent activity. Identity theft is a growing problem, and it can have a serious impact on your credit score. By regularly reviewing your credit report, you can catch any suspicious activity early and take steps to protect your credit. If you do find errors on your credit report, it's important to take action to correct them. You can dispute errors with the credit bureaus and provide documentation to support your claim. The credit bureaus are required to investigate your dispute and correct any errors they find. In conclusion, your credit report is a powerful tool that can help you take control of your financial future. By regularly reviewing your credit report and taking steps to improve your credit score, you can open doors to better financial opportunities. Remember, knowledge is power. Stay informed, stay vigilant, and take charge of your financial health. Welcome back, folks. We're on our journey to conquer those credit scores, and in the last chapter, we talked about the importance of regularly checking your credit report. But what happens when you spot an error? Do you just shrug your shoulders and accept it? Absolutely not. Finding an error on your credit report can be frustrating, but don't let it discourage you. You have the right to dispute any inaccurate information, and trust me, it's a right you should exercise. Remember, those credit bureaus aren't perfect. They handle millions of pieces of data, and mistakes can happen. It's your responsibility to catch those mistakes and fight for your financial well-being. So, if you find something that's not right, it's time to take action. Want to know the golden rule of a good credit score? Pay your bills on time. It's not rocket science, folks. It's about showing those lenders you're responsible with their money. Think about it. If you lend someone a lawnmower, you expect it back when they promised, right? Same goes for credit. When you pay on time, month after month, you build trust. And trust, my friends, is what gets you a good credit score. It tells lenders you're not a risk, that you keep your word. So set reminders, automate payments, do whatever it takes to never miss a due date. Your credit score will thank you for it. All right, folks, let's talk about debt. It's the biggest drain on your finances and a major roadblock to building wealth. But don't worry, we're going to tackle it head-on with the debt snowball. Here's how it works. List all your debts from smallest to largest, regardless of interest rates. Now, throw every dollar you can at that smallest debt while making minimum payments on everything else. Once that first debt is gone, take the money you were paying on it and add it to the payment of the next smallest debt. Keep rolling that snowball until you're debt-free. All right, folks, let's talk about credit inquiries. These little buggers can ding your credit score if you're not careful. So, what exactly are they? Every time you apply for a new credit card, loan, or even an apartment, the lender checks your credit report. This is a credit inquiry. It's their way of assessing your credit worthiness. Now, a few inquiries here and there won't hurt you too much. But if you're constantly applying for new credit, it can raise red flags for lenders. We're talking about building a strong credit score, folks, and that's a marathon, not a sprint. Just like a marathon, building a good credit score takes time, patience, and consistent effort. You can't expect to have a stellar credit score overnight, just as you can't expect to run a marathon without proper training and preparation. It's a long-term commitment that requires you to be diligent and responsible with your financial habits. One of the biggest factors is time. Time is a crucial element in the world of credit. The longer you have been using credit responsibly, the better it reflects on your credit score. It's like aging a fine wine. The longer it ages, the better it gets. Similarly, the longer your credit history, the more reliable you appear to lenders. They want to see a track record that shows you can manage credit over an extended period. That's right, the length of your credit history matters a whole heap, It's not just about having credit, it's about how long you've had it. A longer credit history provides more data points for lenders to assess your creditworthiness. It shows them how you've handled credit over the years, through good times and bad. Have you made your payments on time? Have you kept your balances low? These are the questions lenders are looking to answer when they review your credit history. You see, lenders want to see that you've been playing the credit game for a while, and more importantly, that you've been playing it right. They want to know that you understand how to manage credit responsibly. This means making your payments on time, not maxing out your credit cards, and not applying for too much new credit at once. It's about showing that you can handle the responsibility that comes with having credit. A long credit history tells them you're responsible, that you can handle debt, and that you're not some fly-by-night risk. It shows that you have a proven track record of managing credit wisely. This can make a big difference when you're applying for a loan or a credit card. Lenders are more likely to approve your application and offer you better terms if they see that you have a long history of responsible credit use. Now, you might be tempted to close old accounts, especially if they have annual fees or bad memories attached. But hold your horses. Closing old accounts can actually do more harm than good. Those old accounts are part of your credit history, and closing them can shorten the length of your credit history. This can have a negative impact on your credit score. Instead of closing old accounts, consider keeping them open and using them occasionally to keep them active. Closing those accounts can actually hurt your score, especially if they're some of your oldest ones. Your oldest accounts are the foundation of your credit history. They show how long you've been using credit and how well you've managed it over the years. Closing these accounts can shorten your credit history and lower your credit score. It's important to keep these accounts open and in good standing to maintain a strong credit history. Think of it like this. Each credit account is like a building block in your credit history. Each account adds to the overall structure of your credit profile. The more accounts you have, and the longer they've been open, the stronger your credit profile becomes. It's like building a tower with blocks. The more blocks you have, the taller and more stable your tower will be. The more blocks you have, and the longer they've been there, the stronger your foundation. A strong foundation is essential for a solid credit profile. It shows that you have a long history of responsible credit use, which can make you more attractive to lenders. They want to see that you have a stable and reliable credit history, and the more accounts you have, the better it looks. Don't go knocking down those blocks unless you absolutely have to. It's important to keep your credit accounts open and in good standing to maintain a strong credit history. Closing accounts can shorten your credit history and lower your credit score, so only close accounts if it's absolutely necessary. By keeping your accounts open and using them responsibly, you can build a strong credit history that will serve you well in the long run. Now, let's dive deeper into the specifics of how time impacts your credit score. When we talk about the length of your credit history, we're referring to several key factors. First, there's the age of your oldest account. This is the account that has been open the longest and provides the most historical data for lenders to review. The older this account is, the better it is for your credit score. It shows that you have a long track record of managing credit. Next, there's the average age of all your accounts. This is calculated by adding up the ages of all your accounts and dividing by the number of accounts you have. A higher average age indicates that you have a more established credit history. This is why it's important to keep your old accounts open, even if you're not using them regularly. They contribute to the overall age of your credit history and can help boost your credit score. Another important factor is the age of your newest account. Opening new accounts can lower the average age of your credit history, which can have a negative impact on your credit score. This is why it's important to be cautious about opening new credit accounts. Only open new accounts when it's necessary and when you can manage the additional credit responsibly. It's also important to consider the frequency of new account openings. If you're opening new accounts frequently, it can signal to lenders that you're taking on too much new credit too quickly. This can be a red flag and can lower your credit score. It's best to space out new account openings and only apply for new credit when you really need it. Now, let's talk about how you can build a strong credit history over time. The first step is to start early. The sooner you start using credit responsibly, the longer your credit history will be. If you're just starting out, consider applying for a secured credit card or becoming an authorized user on someone else's account. This can help you establish a credit history and start building a positive credit profile. Once you have credit accounts, it's important to use them responsibly. This means making your payments on time, keeping your balances low, and not applying for too much new credit at once. It's also important to monitor your credit regularly. Check your credit report at least once a year to make sure there are no errors or fraudulent accounts. You can get a free credit report from each of the 3 major credit bureaus once a year at annualcreditreport.com. If you find any errors on your credit report, it's important to dispute them right away. Errors can lower your credit score and make it harder to get approved for credit. You can dispute errors by contacting the credit bureau that issued the report and providing documentation to support your claim. The credit bureau is required to investigate your dispute and correct any errors within 30 days. Another important aspect of building a strong credit history is managing your credit utilization. This is the amount of credit you're using compared to your total credit limit. It's best to keep your credit utilization below 30% to maintain a good credit score. If you're using too much of your available credit, it can signal to lenders that you're overextended and may have trouble making your payments. One way to manage your credit utilization is to pay down your balances. If you have high balances on your credit cards, focus on paying them down as quickly as possible. This can help lower your credit utilization and improve your credit score. Another strategy is to ask for a credit limit increase. If you have a good payment history, your credit card issuer may be willing to increase your credit limit, which can lower your credit utilization. It's also important to avoid closing old accounts, as we've discussed earlier. Closing old accounts can shorten your credit history and lower your credit score. Instead, keep your old accounts open and use them occasionally to keep them active. This can help maintain the age of your credit history and contribute to a strong credit profile. In addition to managing your credit accounts, it's important to diversify your credit mix. Lenders like to see that you can manage different types of credit, such as credit cards, installment loans, and mortgages. Having a mix of credit accounts can help boost your credit score and show lenders that you can handle different types of credit responsibly. If you're just starting out, you may not have a lot of different types of credit. That's okay. Focus on building a positive credit history with the accounts you have, and over time, you can add different types of credit as needed. For example, you might start with a credit card, then add a car loan or a personal loan, and eventually a mortgage. It's also important to be patient. Building a strong credit history takes time, and there are no shortcuts. It requires consistent effort and responsible credit management, but the rewards are worth it. A strong credit history can help you get approved for loans and credit cards, qualify for better interest rates, and even save money on insurance premiums. In conclusion, the value of time in building a strong credit history cannot be overstated. The longer you have been using credit responsibly, the better it reflects on your credit score. It's important to start early, use credit responsibly, and be patient. By keeping your accounts open, managing your credit utilization, and diversifying your credit mix, you can build a strong credit history that will serve you well in the long run. Remember, building a good credit score is a marathon, not a sprint. Stay the course, and you'll reach the finish line with a strong credit profile. All right, folks, let's talk about those of you who are starting from scratch with credit. Maybe you're fresh out of school, just starting your first job, and you haven't had the chance to build up any credit history yet. Or perhaps you've had a few bumps in the road, missed payments, high balances, or even a bankruptcy. Whatever your situation, it's never too late to start over and rebuild your credit. Now, I know the thought of credit cards can send shivers down your spine. The idea of getting into debt, dealing with high interest rates, and managing monthly payments can be overwhelming. But listen up, because there's a tool that can help you get back on track: the secured credit card. A secured credit card can be your ticket back to good credit. It's designed specifically for people who are looking to build or rebuild their credit. Think of it as a stepping stone, a way to prove to lenders that you can be responsible with credit. Think of it like training wheels for your credit score. Just like training wheels help you learn to ride a bike without falling over, a secured credit card helps you build your credit without the risk of getting in over your head. It looks and acts like a regular credit card, but there's a safety net. You see, with a secured card, you put down a security deposit, usually a couple $100. That becomes your credit limit. This means that if you don't pay your bill, the lender can use your deposit to cover the balance. This deposit minimizes the risk for the lender, and more importantly, it gives them the confidence to give you a chance to prove yourself. By using the card responsibly, making small purchases, and paying off the balance in full each month, you can start to build a positive credit history. This deposit minimizes the risk for the lender, and more importantly, it gives them the confidence to give you a chance to prove yourself. By using the card responsibly, making small purchases, and paying off the balance in full each month, you can start to build a positive credit history. And here's the best part. As you demonstrate your ability to manage credit, your credit score will improve. Over time, you may even be able to transition to an unsecured credit card, which doesn't require a deposit and often comes with better terms and rewards. Now, don't go thinking this is a free pass to spend recklessly. The key here is responsibility. Just because you have a credit limit doesn't mean you should max it out. In fact, it's best to keep your balance low, ideally below 30% of your credit limit. This shows lenders that you're not relying too heavily on credit and that you can manage your finances wisely. The key here is responsibility. Make a budget and stick to it. Track your spending and make sure you're not overspending. Set up automatic payments or reminders so you never miss a due date. And most importantly, pay off your balance in full each month to avoid interest charges and keep your credit utilization low. It's also important to monitor your credit report regularly. You can get a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year at annualcreditreport.com. Review your report for any errors or inaccuracies and dispute them if necessary. Keeping an eye on your credit report can help you catch any potential issues early and ensure that your credit history is accurate. Another tip is to avoid applying for too many credit accounts at once. Each time you apply for credit, it results in a hard inquiry on your credit report, which can temporarily lower your credit score. Instead, focus on building a solid credit history with 1 or 2 accounts before applying for additional credit. And remember, building credit takes time. It's not something that happens overnight. Be patient and stay committed to your financial goals. With consistent, responsible credit use, you'll see your credit score improve over time. In conclusion, a secured credit card can be a powerful tool for rebuilding your credit. It provides a way to demonstrate your creditworthiness to lenders while minimizing their risk. By using the card responsibly, monitoring your credit report, and staying committed to your financial goals, you can take control of your credit and set yourself up for a brighter financial future. So, if you're looking for a second chance at credit, consider a secured credit card. It might just be the fresh start you need to get back on track and achieve your financial dreams. Remember, it's never too late to start over. With the right tools and a commitment to responsible credit use, you can rebuild your credit and create a solid financial foundation for the future. Good luck and happy credit building. Thank you for watching, and don't forget to subscribe for more tips on managing your finances and building a better financial future. Now, let's talk about a little-known credit-boosting secret: becoming an authorized user. This strategy can be a game changer for those looking to improve their credit scores without having to go through the lengthy process of building credit from scratch. It's a method that not many people are aware of, but it can be incredibly effective if done correctly. This is where having a trusted friend or family member with great credit can really come in handy. Imagine having someone in your life who has a stellar credit history and is willing to help you out. By becoming an authorized user on their credit card, you can benefit from their positive credit behavior. It's like having a financial mentor who is willing to lend you their good credit reputation. It's like hitching your wagon to a star, credit-wise. When you become an authorized user, the primary cardholder's credit history starts to reflect on your credit report. This means that their timely payments, low credit utilization, and overall responsible credit management can positively impact your credit score. It's a way to fast-track your credit-building journey. See, when you become an authorized user on someone else's credit card, their positive credit history gets factored into your credit score. This can be especially beneficial for young adults or individuals who are new to credit. Instead of starting from zero, you get a head start by leveraging someone else's established credit history. It's like getting a boost in a race where every point counts. It's like borrowing a good reputation, and the best part is, the account holder doesn't even have to give you access to the card. You don't need to worry about spending limits or managing another card. The primary cardholder can keep the card, and you still reap the benefits of their good credit behavior. It's a win-win situation for both parties involved. Now, I know what you're thinking. Dave, is this even legal? It sounds too good to be true, right? But rest assured, this is a perfectly legal and widely accepted strategy for building credit. Financial experts and advisors often recommend it as a viable option for those looking to improve their credit scores quickly and effectively. Yes, folks, it's perfectly legal and a common strategy for building credit. Many people have successfully used this method to boost their credit scores and achieve their financial goals. It's a testament to the power of collaboration and trust in personal finance. By working together, we can help each other achieve financial success. But, and this is a big but, it only works if the primary cardholder is responsible with their credit. If the primary cardholder has a history of missed payments, high credit utilization, or other negative credit behaviors, it can actually harm your credit score. So, it's crucial to choose someone who has a strong track record of responsible credit management. Trust and communication are key in this arrangement. When selecting a primary cardholder, make sure to have an open and honest conversation about their credit habits. Discuss their payment history, credit utilization, and overall financial behavior. It's important to ensure that they are committed to maintaining good credit practices, as their actions will directly impact your credit score. Additionally, it's essential to set clear expectations and boundaries. Make sure both parties understand the terms of the arrangement and agree on how the credit card will be managed. This includes discussing whether the authorized user will have access to the card, how payments will be handled, and any other relevant details. Clear communication can prevent misunderstandings and ensure a smooth credit-building process. Becoming an authorized user is just one of many strategies to build credit. It's important to explore other options as well, such as applying for a secured credit card, making timely payments on existing debts, and keeping credit utilization low. A well-rounded approach to credit management can help you achieve a strong and healthy credit score over time. Remember, building credit is a marathon, not a sprint. It takes time, patience, and consistent effort to achieve and maintain a good credit score. By leveraging the authorized user strategy and combining it with other credit-building practices, you can set yourself up for long-term financial success. In conclusion, sharing is indeed caring, especially when it comes to credit. By becoming an authorized user on a trusted friend or family member's credit card, you can benefit from their positive credit history and give your own credit score a significant boost. Just remember to choose a responsible primary cardholder, communicate openly, and combine this strategy with other credit-building practices for the best results. So, if you're looking to improve your credit score, consider reaching out to someone you trust and exploring the authorized user strategy. It could be the key to unlocking new financial opportunities and achieving your goals. After all, in the world of personal finance, sharing truly is caring. We're talking about building a strong credit history, folks, and just like you don't want all your eggs in one basket, you don't want just one type of credit. Lenders like to see a healthy mix. It shows you can handle different types of debt responsibly. Think about it. A credit card, a mortgage, maybe an auto loan, each demonstrates a different aspect of your financial management. It's like a balanced diet for your credit report. All right, folks, let's talk about a term you need to know: credit utilization ratio. This term might sound a bit intimidating at first, but trust me, it's a fundamental concept that can significantly impact your financial health. Understanding it can help you manage your credit more effectively and improve your credit score over time. Sounds complicated, but it's really pretty simple. The credit utilization ratio is essentially a measure of how much of your available credit you're using at any given time. It's expressed as a percentage and is calculated by dividing your total credit card balances by your total credit card limits. It's basically how much of your available credit you're actually using. For example, if you have several credit cards with different limits, the credit utilization ratio takes into account the combined balances and limits of all those cards. Think of it like this. You have a credit card with a $10,000 limit, and you've got a $3,000 balance. In this case, your credit utilization ratio is 30%. This means you're using 30% of your available credit on that card. That means your credit utilization ratio is 30%. Easy, right? But remember, this is just one card. If you have multiple cards, you need to consider the total balance and total credit limit across all your cards to get an accurate picture of your overall credit utilization ratio. Section 2. Why it matters. The 30% rule. Now, you might be wondering why this ratio is so important. Well, it plays a crucial role in determining your credit score, which is a key factor that lenders use to assess your credit worthiness. Now, why should you care about this ratio? Because it plays a big role in determining your credit score. Your credit score is a numerical representation of your credit worthiness, and it affects your ability to get loans, credit cards, and even rental agreements. Because it plays a big role in determining your credit score. A high credit utilization ratio can negatively impact your credit score, making it harder for you to get approved for new credit or loans. On the other hand, a low credit utilization ratio can boost your credit score and make you a more attractive borrower to lenders. Lenders look at it as a measure of how risky you are as a borrower. If you're using a large portion of your available credit, it might indicate that you're over-reliant on credit and could be at a higher risk of defaulting on your payments. The lower your utilization ratio, the better. Ideally, you should aim to keep your credit utilization ratio below 30%. This means using less than 30% of your available credit on each card and overall. Aim for 30% or less on each card and overall. This is often referred to as the 30% rule. By keeping your credit utilization ratio low, you can improve your credit score and demonstrate to lenders that you manage your credit responsibly. If you're constantly maxing out your cards, it sends a red flag to lenders that you might be living beyond your means. High credit utilization can signal financial distress and make it more difficult for you to get approved for new credit or loans. So, how can you manage your credit utilization ratio effectively? First, regularly review your credit report to understand your current credit utilization and identify areas for improvement. This will help you stay on top of your credit usage and make necessary adjustments. One effective strategy is to set up automatic payments to ensure you pay off your balances on time. This can help you avoid late fees and reduce your overall credit card balances, thereby lowering your credit utilization ratio. Another important step is to create a budget and stick to it. By planning your expenses and avoiding unnecessary purchases, you can keep your credit card balances low and maintain a healthy credit utilization ratio. If you have high balances on multiple cards, consider transferring them to a card with a lower interest rate. This can help you pay off your debt faster and reduce your credit utilization ratio. You can also request a credit limit increase from your credit card issuer. If approved, this will increase your available credit and lower your credit utilization ratio, as long as you don't increase your spending. Paying off your credit card balances in full each month is another excellent way to keep your credit utilization ratio low. This not only helps you avoid interest charges, but also demonstrates responsible credit management to lenders. Consider using a credit monitoring service to keep track of your credit utilization ratio and receive alerts if it starts to creep up. This can help you take proactive steps to manage your credit and maintain a healthy credit score. By following these strategies, you can effectively manage your credit utilization ratio and improve your credit score over time. Remember, maintaining a low credit utilization ratio is key to demonstrating responsible credit behavior and achieving financial stability. In summary, the credit utilization ratio is a crucial factor in your overall financial health. By understanding how it works and taking steps to manage it effectively, you can improve your credit score, reduce your borrowing costs, and achieve your financial goals. So, take control of your credit utilization ratio today. Review your credit report, Create a budget, pay off your balances, and monitor your credit regularly. With these steps, you'll be well on your way to a healthier financial future. Thanks for watching. If you found this video helpful, don't forget to subscribe to our channel for more financial tips and advice. Stay tuned for more videos to help you achieve your financial goals.